Today we'll talk about infinite banking and whole life insurance. We'll talk about how to set up a whole life insurance policy for infinite banking, and then how you can use a whole life insurance policy for infinite banking. Let's get on into it. So the idea of infinite banking or bank on yourself, they're the exact same thing. What this is, it is a concept that teaches one how to use a whole life insurance policy as their own bank or as their own financing tool. I often like to describe it as your own personal line of credit. The reason why is because you're building up a pool of capital or cash value in a whole life insurance policy, and then you're using that cash value to invest in opportunities, make large purchases, and you're using your whole life insurance policy instead of going to a bank and financing that large purchase or opportunity with the bank. So we'll provide more detail, but let's start with an example of just going to a bank. So let's pretend that you go to a bank because you want to buy a property, so you're going to borrow money from them. The terms of that loan are set by the bank. You make payments, you also pay interest that goes to the bank. A classic example would be a mortgage. The info you'll see here is based on a mortgage we recently looked at for someone. It was a 30-year term. Their monthly payment was just under $3,000. Their interest rate is 6.63%. If they do nothing other than just pay their monthly payment for the next 30 years, they will have paid a total of just about $1,060,000, of which $460,000 is a return of principal. That's how much they borrowed from the bank to purchase their home. And then the other $600,000 is interest that goes to the bank. So that's the bank's profit there. So if this is you, who's in control of this loan? The bank. Who makes the money in this particular example? The bank. So again, this is pre-infinite banking or bank on yourself. Let's look at another example of using a bank. In this case, we're just going to store money in the bank. So if I said, hey, I've got enough money in cash, I don't need to borrow from a bank to buy a property, I can just write a check to purchase this property, which is a very good situation to be in. So if you have the cash on hand, the thing we like to mention here is that money in cash, when you pull it out of your bank account, no longer earns interest. So a very, very simple, to the point example. If I have 100 grand in a bank account and that account is earning 5%, if I take $80,000 out for an opportunity, that means I have $20,000 left in my account. What earns interest? The $20,000. The $80,000 is no longer earning that 5% anymore. So what I have to do then is refill my bank account, which is what most people do, and then when it's filled up again, they'll take that money out and use it for another opportunity. Make sense? Cool. Next, let's look at using infinite banking. So now, instead of doing what we saw over here, we're going to look at using a whole life insurance policy. So when it comes to infinite banking or bank on yourself, this is a solution that for many is viewed as better than working with a bank. Here's some of the benefits. Number one, it gives you control, meaning you control the terms of how and when you pay back loans. Not a bank, not an insurance company, you've got control, which is very nice. Also, your money is working for you when you take loans against your policy. We'll look at a specific example of this, but what you'll see is when you take a policy loan, you continue to earn dividends and interest on the money that you borrowed. Now, a key item of awareness that I like to provide is that the loan interest is paid to the insurance company. It is not paid to yourself. When we look at these concepts, whether it's infinite banking or bank on yourself, a common misunderstanding is one will read about the concept and think that the interest payments they're making always go back to themselves. No. If I see an interest rate on my life insurance policy, that is loan interest that goes to the insurance company. It does not come back to me. That concept of paying yourself back with interest involves you just putting more money into the life insurance policy, which we can do another video on that in the future. So just the key item of awareness, anytime you see loan interest, that is money that goes to the insurance company. So here's how it works. We'll break it down into 3 steps. Step 1, I save money in a whole life insurance policy. That whole life insurance policy builds cash value, and that cash value is viewed as my bank or my source of financing over time. Step 2, I take loans from my whole life insurance policy instead of going to a bank. Here's the key on this. I keep earning interest on the money that I've borrowed against my policy as if I never pulled it in the first place. So unlike the example over here, where I've got a 5% bank account, if I pull out 80 grand, I'm no longer going to earn interest on that $80,000. Whereas with a whole life insurance policy, if I have $100,000 in cash value and it's earning 5%, and I borrow $80,000 against the policy, I still earn that 5% on the full $100,000. You'll see exactly how the insurance company does this when we look at a model in a little bit. So step 2 is I take loans, and then step 3, pretty simple, I repay those loans. You're not required to, but it does make sense. So when I repay the policy loan, what I'll notice is that the cash value is 100% restored to what it would have been as if I never touched it in the first place. So just to summarize this, the idea of using a whole life insurance policy like my own bank, it's a lot like saving cash and then making purchases with that cash, just like the example we looked at over here. But the difference is I'm using a whole life insurance policy instead. I do have to pay loan interest on that, but the benefits I receive, specifically the compound interest I still get on the money that I'm borrowing, exceeds the interest that I'm going to pay to the insurance company. So when I look at the numbers, it works out in my best interest in most cases. I'll explain exactly what that means when we look at the numbers. Okay, so let's break down these 3 steps now. First, step 1, save money in a whole life insurance policy. The cash value is your own bank. Now, here's the most important thing that always gets overlooked, and there's so many opinions on this. With the whole life insurance policy, make sure it's set up for maximum cash value. When people have buyer's remorse about getting a whole life insurance policy and they got it for infinite banking, it's never because of the loans. It always has to do with someone finding out that they got a policy and it could have been set up where they could have had more cash value up front and also more cash value long term. That's where people get upset. So make sure that it's set up for maximum cash value. Because what that does for you is if you have a policy that has more cash value, that means you just have more money for opportunities. So let's go over how to set up a policy for maximum cash value. We'll start with what I would not do. A common setup we see for whole life insurance policies that are set up for bank on yourself or infinite banking is with what's called a 40-60 split. What this has to do with is where your money is going. I'll explain that in a moment. But for example, if I have a 40-60 split, it would mean that I pay $10,000 per year, and my first year cash value is somewhere between $6,000 and $7,000. The break-even point, which is the first year my cash value is equal to the total dollar amount I have paid, usually ranges somewhere between 7 to 10 years. Why does it take so long? Because waiting 7 to 10 years to get your money back, when I hear that, I think, why would I even put money into a policy? I could keep using it just by putting it in the bank, investing in other opportunities, and that'll get me so much further ahead than waiting 7 years just to break even before I see any type of gain. Like, it doesn't make sense. So why it takes so long is if I'm paying $10,000, back to that 40-60 split, the 40% represents what we have here in red, the base premium. What is 40% of $10,000? $4,000. Base premium dollars typically do not build cash value in whole life insurance policies in the first year. The reason why is because the company overcharges me for the life insurance up front. Whereas PUA dollars, which stands for paid up additions rider, if I put the other 60% there, I'm going to have approximately $6,000 in cash value up front. So this guy is what really maximizes my cash value. Here's what I would do. So I can take the exact same policy and set it up where I have what is called a 1090. What this means is if I am funding $10,000 per year, my first year cash value, instead of $6,000 to $7,000, has between $8,000 and $9,000 in cash value. And instead of breaking even between 7 and 10 years, I'm breaking even between 3 and 5 years. Why is it better? Because often it can be the exact same company, and in some cases the exact same product. The reason why is because of that $10,000, where is the money going? $1,000 is going toward the base premium, which does not build any cash value, but I reduce that piece that doesn't give me equity in the first year as low as I can push it. Because if you do that, now you leave more money that can go toward your paid up additions rider. And why it's not zero premium, 100% PUA is because insurance companies do have limits that regulate how much I can put into PUAs on top of my base premium, which in this example, we're assuming one of your 4 major mutual companies, who are Mass Mutual, Guardian, New York Life, and Northwestern Mutual, which allow us to push that minimum premium to about 10% of the total payment. Now, something I always like to mention here, mainly for awareness, is that as an agent, I am incentivized to sell a higher base premium. Because where agents make the majority of their commission with traditional whole life insurance products is in the first year and primarily on the base premium. There are a million opinions and thoughts and comments. We always hear about that, but it's the truth. It's how it works. The higher the base premium is, the more the agent makes in commission. The higher the base premium is, the less the consumer has in cash value, especially up front. All right, let's continue on by looking at an example, shall we? So what we're going to look at is a comparison of these two. What we have first is a 40-60 split. This is with one of the major mutual companies. $20,000 per year. We're going to fund for 15 years. This is on a 35-year-old individual. He wanted to fund until he was 50 years old. $20K goes in. First year cash value, $11,000 and change. What's 20,000 times 10? $200,000. So by the 10th year, he's paid in 200. He has 207. If you subtract one payment in year 9, how much would he have paid? 20,000 times 9 years is 180,000, and he has just about $180,000. Versus a 1090 design. Let's take a look, shall we? Still Mass Mutual. What do you notice? Well, 20,000 goes in. Here's your cash value, $18,000 in the first year. Your base premium is up here. And we also have term insurance riders attached. You can actually see them over here. The purpose of that is it prevents what is called a modified endowment contract, or MEC, which is a taxable event with a life insurance policy. Why folks are often interested in this is because cash value life insurance is a safe place I can put money. I can access it through the loan feature, which we're going to look at next. And if I do everything right and don't trigger a MEC, I can access it tax-free. And I don't mess it up in other ways. But this is the 1090 design. Let's take a look at a side-by-side comparison, shall we? Here we go. There's the 40-60 on the left. What's highlighted in yellow is your break-even point. That's year 9. And then here is our 1090 design. Break-even point is year 4. If we look at this by year 25, the cash value difference is quite substantial. The 1090 has $721. That 40-60 design has about $630,000. So you can see a big difference, and as time passes, it is just amplified as well. So, how to set up a policy for maximum cash value? What we want to aim for is reducing the base premium as low as the insurance company will allow us. That allows us to put more money into our PUA rider, and what it also does is make for a very flexible policy. That example you saw where he was paying $20,000 per year, he was not obligated to pay that. The minimum commitment was about $2,000 plus the cost of the term, so maybe $2,200 or $2,300 per year. All right, let's talk about loans. We talked about how to set it up. Now, how do I use it? So I take loans from my whole life insurance policy, and I'm doing this instead of going to a bank. So, example, if I have $100,000 in cash value, and in 10 years, it's going to be worth $200,000. What I can do with a whole life insurance policy is today, when it's worth $100,000, I can take a $50,000 loan or $90,000 loan. It could be any dollar amount, but I've got access to that, and I know it's still going to be worth that $200,000 figure in 10 years if I pay that loan back. So let's assume that the interest is 5%. That'd be $2,500 that is paid to the insurance company. And that'd be every year if I'm paying the interest on that loan every year. Now, before we look at the repayment, a couple facts here. When it comes to policy loans, you can access them anytime you want. It can be as early as 10 business days after starting a policy. You can access them through your online account, or you can reach out to your agent. They're often sent via direct deposit. Payments are up to you. You can log onto your portal and pay them manually, or you can set up automatic loan payments. The loan interest rate, as of the date of shooting this video, is between 5% and 6% with most insurance companies, and you'll find both fixed and variable rates available depending on the companies and products that you look at. And this is considered a private contract. What that means is it has no impact on your credit score. When you hear the word loan, what typically comes to mind? Payments and interest. It's going to impact my credit score. You won't see that with a life insurance policy. It's completely separate from all of that, which is nice. So let's wrap up by looking at paying the loan back. So step 1, saving. Step 2, taking loans. Step 3, repaying the policy loan. My money's growing the whole time. So with that same example, I had $100,000 in cash value. I took a $50,000 loan. I paid interest to the insurance company. Let's pretend I pay it back in 10 years. My cash value is still worth $200,000. Here's the big difference, though, between this and taking a loan from a bank. I controlled the payments, and my money kept on compounding for me. And then some people say, I'm tired of working with banks, so I don't have to work with them anymore either, which is true. And that's my fancy artwork. Anyway, that's an overview of how it works. Let's conclude by looking at some actual numbers, shall we? So, what we're going to look at is an illustration of a 35-year-old individual, but someone who wanted to aggressively fund a policy with $200,000 over 4 years. There's $50K per year going in. There's his cash value. This is an example where he pays money in and just lets it sit and grow. Look at your year 10 cash value. $268,796. Have that number in mind. $268,796. Here's the exact same policy, except we're taking a policy loan. A loan of $150,000, and then we repay it back. At the end of the road, his cash value, $268,796. He kept earning interest the whole time, even though a loan was outstanding. Let's look at a cleaner picture of this. Here we go. So, on the left, we've got the growth illustration. To the right, we've got our loan illustration. Through the 4th year, everything is identical because we have not pulled any money out. Exact same policy. Now, we're going to take that $150,000 loan. So we take that $150,000 loan. We don't make any payments in the first year in this example. Okay. Then we begin to repay it at $40,000 per year. Now we mentioned earlier that interest does go to the insurance company. So of that $40,000 payment, I can see how much is applied to principal and then how much is applied to interest every year. So I can see exactly what I'm paying to the insurance company. And as I am repaying that loan, my cash value or equity that I have access to is restored, and my death benefit is restored as well. What you'll notice is anytime you take a loan, your cash value reduces approximately by the amount that you borrow, and your death benefit does reduce dollar for dollar by the amount that you borrow. So, any questions here? I would have a question, which would be, what's the spread? I'm paying interest to them, but how much are they paying me? So, let's take a look. What we have here is our net cost. This also highlights the drawbacks, which are the early years. So here we go. That's better. Cash value growth, first and second year. I have a loss because I received less than $50,000 per year, which is the amount I paid. But if we focus on the loan here, first year I pay interest, $7,605. I gained $10,554, which means I have a net spread of about $3,000. I'm positive, which is nice. Now, what would happen if we took a $150,000 loan in the fourth year? Because we can do that. Well, the cost to borrow would be the same, and the growth would be the same. But I would have a negative spread because my cost to borrow is exceeding the cash value growth. So this is one of the things we like to look at with everyone we work with to make sure that when they borrow, they're aware if they're positive or negative. And it's pretty simple to do. We just lay their life insurance policy out, model any loans that they're going to take, and let them look at the net growth versus the net cost year over year, and then see the spread. But this helps us see exactly how we can use a policy and if it is truly in our best interest if we like looking at the numbers. So, overall, how we set up whole life insurance policies. If someone's interested in using it for banking concepts, infinite banking, bank on yourself, whatever it might be, the first thing we like to do is set it up for as much cash value as possible. This gives us more money for more opportunities. And then number two, look at how we can use it. What we like to look at is what we just saw with loans taken, then loans being repaid. What we also like to look at that we did not view in this video are some worst case scenarios, such as what do things look like if I never pay any loans back? This way I have the awareness up front. So with all of that said, I do hope that you enjoyed this video. Please let us know your thoughts and if you have any questions at all. And as always, I hope this helps.